Right, let's unpack this. Today, we are undertaking a deep dive into a company that I think a lot of people, well, they misunderstand it. They tend to see it through a very narrow lens.
Oh, absolutely. The view is usually just fitness wearables or maybe those, legacy car navigation unit.
Exactly. But for the critical investor, Garmin is. It's just so much more interesting. It's this distinct anomaly in the technology hardware sector.
A true diversified compounder. I
Yeah.
mean, it's not just one thing. It successfully bridges high-volume consumer electronics,
Like your running watch.
right, with this highly regulated, deeply industrial technology. Think aviation electronics.
And that unique structural bridge is, I think, precisely what makes Garmin so fascinating. But it also makes it highly contentious among really astute investors.
It does, because we're scrutinizing GRMN at a really critical inflection point. The operational and financial execution is, well, frankly, it's stellar.
The numbers are incredible.
They are. We're looking at record performance. I mean, $6.3 billion in revenue for fiscal year 2024, and that momentum is continuing right into the third quarter of 2025 with $1.77 billion in revenue. It's a story of consistent, disciplined growth.
Absolutely. The quality is undeniable. But our mission today is to figure out whether that quality, that consistency, actually justifies the premium valuation the market has put on the shares.
That's the key question.
We have this exceptionally profitable, capital-efficient operator, but it's trading at a significant premium to its own history and to its peers. We're hovering around, 25 times forward earnings estimates?
And that valuation creates a profound tension. We've certainly seen cautionary notes, even from institutional investors who are known for their high-quality focus.
Right, like Upslope Capital.
Exactly. We know that Upslope Capital Management reduced their position, and they said it explicitly. A significant amount of good news is clearly baked into shares.
So our core question today is pretty straightforward, but it's critical. Do the company's structural advantages, this moat of utility they have, justify buying or even holding shares at this high a price?
Or does the current valuation just leave absolutely zero margin of safety for the high IQ investor? That's what we need to figure out.
I agree, and I think we have to establish the operational foundations before we can even start to talk about price. So let's define our analytical path here.
Let's do it.
We have to look past, the shiny AMOLED screens on the new Epix watches and really understand the industrial strength engine that's operating just beneath the surface.
Precisely. To justify a 25x multiple, that moat has to be structural, not temporary. So we have to analyze the operational bedrock, which I think is their extreme vertical integration.
Okay, vertical integration first, then what?
Then we'll dissect the segment profitability. It's a portfolio of 5 businesses, and we need to separate the high-margin compounding winners from the necessary but costly structural drag.
And finally?
And finally, we scrutinize that fortress balance sheet against the new permanent and non-operational headwind that's quietly chipping away at their net income.
The rising effective tax rate.
That's the one. We just can't judge the fairness of the price until we fundamentally grasp how, and more importantly why, Garmin earns its money.
Okay, let's start with that moat, because in the tech sector, especially hardware, it's usually just a race to the bottom, right? Margins get crushed by commoditization.
They do.
Yet Garmin somehow maintains this exceptional profitability and resilience. And the key, as you just pointed out, seems to be their unconventional operational structure.
It is the defining feature of the business, and it flies in the face of modern consumer electronics manufacturing.
So they're not just another design house that contracts everything out to a third party.
No, not at all. Garmin is not reliant on third-party original design manufacturers, or ODMs. They operate as a true, vertically integrated manufacturer.
Meaning they control the entire stack.
The entire stack. From the initial industrial design, chip design, right through manufacturing, they've got major facilities in Taiwan and the U.S., all the way to marketing, distribution, and sales. They own the process.
And this full control isn't just, a quaint operational choice. It's translated into massive financial and strategic benefits, especially when the global supply chain, like it did recently, just descends into chaos.
That's the critical battle-tested advantage. We have to remember that component shortage crisis that just gripped the industry through 2022 and 2023.
A nightmare for most hardware companies.
It was. While major competitors who rely on those external ODMs were experiencing severe stockouts because they were third or fourth in line for critical chips, Garmin maintained remarkable inventory levels.
Oh, why?
Because they had the in-house engineering capability to redesign their printed circuit boards, their PCBs, on the fly. They could literally substitute an unavailable chip with one that was available by adapting their own software and hardware interfaces in a matter of weeks.
That's the strategic difference, isn't it? Being a customer who is dependent on your supplier versus having direct real-time control over your own engineering solutions.
It gave them radical supply chain agility, and it allowed them to capture market share during a period of intense scarcity.
And the financial outcome was just superior. That agility meant they could maintain their premium pricing and even, expand their margins during the shortage?
They expanded their margins, while competitors were forced to stall production or slash prices just to move old inventory. It was a massive win.
But I have to ask the critical question here. Doesn't owning that whole manufacturing stack expose them to greater fixed overhead risk during a downturn, compared to a more flexible variable cost model from an ODM?
That is the essential trade-off, and it's one management consciously makes. They absorb that higher fixed overhead, the cost of the plant, specialized engineering staff, to ensure two things.
The agility we just discussed is one. What's the other?
Quality and trust, especially in their regulated segments.
Right, because in aviation and marine, a device failure isn't just a mild inconvenience like your phone screen freezing.
No, it can be life-threatening.
So reliability is non-negotiable.
Precisely. By owning the manufacturing and testing stack, Garmin ensures this stringent quality control. And that is the foundational justification for their pricing power in these regulated markets. They're selling utility and trust, not just a piece of hardware.
So the vertical integration, it's not just about logistics. It's about establishing the non-commodity nature of the product, which is what justifies that extraordinary margin.
And that's the third financial pillar. By owning the whole process, Garmin captures the margin that would otherwise be given away to those third-party ODMs. This is the bedrock that allows them to drive consolidated gross margins consistently near 59%.
59%. Just to put that into perspective for a high IQ investor, a 59% gross margin in the tech hardware sector is staggering.
It's often 15, even 20 percentage points higher than the industry median. It just screams deep structural pricing power.
Okay, 59% is truly exceptional. Now, let's shift from the operational structure to how they manage the cost side, specifically that R&D spend. They invested a huge amount, nearly $1 billion, $994 million in R&D in 2024.
It's a heavy weight, for sure. But they leverage it beautifully through what you could call shared technologies across their conglomerate model.
This is the genius of their multi-vertical structure, isn't it?
It really is. They don't have to reinvent the wheel 5 times. They develop a core competency, once a technology, an algorithm, and then they amortize that nearly $1 billion R&D cost across 5 distinct high-revenue verticals.
Which means that massive revenue base lets them spread the expense much more thinly than a pure-play competitor could.
Exactly. It creates a powerful, almost insurmountable barrier to entry for smaller firms that just can't match that scale or breadth of features.
It's the ultimate capital efficiency hack. You get 5 products for the price of 1 development budget. What are some of the most powerful examples of this synergy?
Well, let's start with the foundational technology. High-precision GNSS, the Global Navigation Satellite System tech. This is what delivers centimeter-level positioning accuracy.
And it was initially developed for the really precise, safety-critical needs of aviation and high-end marine systems.
Exactly. That required years of investment and certification work. The cost to develop that initial platform was astronomical.
But once they developed it...
Once it was developed, it was miniaturized and rolled out almost for free, from an R&D perspective, into their outdoor handhelds and, critically, into their high-volume fitness watches.
So the consumer segment gets the benefit of industrial-grade location accuracy, which was paid for by the high-margin industrial segments.
That's a fantastic case study in smart capital allocation. You develop cutting-edge tech for an extensive regulated market, and then you get a free ride rolling it out to high-volume consumer products where it becomes a clear point of differentiation.
We see the same pattern with power management, right? Which is maybe their most enduring consumer advantage.
The identical pattern. Yeah. The specialized chips and software that are required for those long-duration expedition profiles in the high-end Fenix line.
The watches that last for weeks, not days.
Right. Those are then adapted for the high-volume Forerunner running watches and the newer Epic series. This core competence gives Garmin a distinct structural battery life advantage over pretty much every competitor.
Especially those relying on power-hungry operating systems and displays, like in the general smartwatch market.
And that distinction, 20 days of battery life versus charging every 2 days, That's a performance factor that their target demographic, the serious athlete, prioritizes above almost everything else. It's a competitive edge sustained by their legacy R&D.
And they enhance this with focused acquisitions, too.
They do. The purchase of Firstbeat Analytics, for example, wasn't about hardware. It was about sophisticated physiological monitoring algorithms.
Like heart rate variability and training status metrics.
Exactly. And those are now standardized across their entire wearable portfolio. Fitness, outdoor, even the specialized marine watches like the Quatix series. This creates a unified, complex health ecosystem.
Which significantly increases switching costs for the user. Your entire performance history is now locked into the Garmin Connect platform.
It's a software moat built on top of leveraged hardware superiority.
Let's shift our focus to the raw financial quality. When we're talking about compounding value, we have to scrutinize the margin structure, the cash flow quality, and most importantly, the effectiveness of capital deployment.
ROI.
Return on invested capital. So how is that margin profile trending beyond that impressive 59% gross figure?
The margin trend is structurally positive, and that speaks volumes about management's discipline. Gross margins expanded steadily. They reached 59.1% in Q3 2025. That's a noticeable improvement from 57.5% in fiscal year 2023.
And that's not arbitrary. It's driven by conscious factors, the first being the favorable mix shift, I imagine.
Correct. A significant shift toward their higher margin premium products. We're talking about the high-end Phoenix 8 Pro, the Epix watches, and on the industrial side, that lucrative aviation retrofit business.
And those carry much higher margins.
Significantly higher. Often in the mid-60s, which directly boosts the consolidated average. They're moving the volume needle with high-value units.
So they're successfully pushing customers up the value chain. What's the second factor providing this tailwind?
It's the normalization of global freight costs post-2023. That provided a substantial, though probably non-recurring, tailwind. The easing of logistics expenses just naturally lowers the cost of goods sold.
But what's truly impressive for a business with high fixed costs is the operating leverage they're showing.
That's where it gets interesting. Operating margins increased sharply from 20.9% in 2023 to a substantial 25.8% in Q3 2025.
That nearly 5-point jump in such a short period is a clear indicator of mature financial scaling. It tells us the business is absorbing its fixed infrastructure much more efficiently as revenue scales.
It demonstrates strong operating leverage. As revenue scales, the company's large fixed costs, like that billion-dollar R&D budget, their manufacturing infrastructure, SG&A, are being absorbed more effectively.
So a much higher percentage of each new dollar of revenue drops straight to the bottom line.
The textbook definition of a high-quality compounder.
Here's where it gets really interesting.
Yeah.
Let's talk about return on invested capital, ROIC. For a high IQ investor, this is the paramount metric. How efficient are they at turning reinvested capital into growing profit?
Okay, so their trailing 12-month, or a TTM, ROIC as of late 2025 is reported at about 19.4%.
Which is a great number on its own.
It is. But to understand the value creation, you have to compare that against their weighted average cost of capital, or WACC. We'd estimate Garmin's WACC, given its fortress balance sheet, to be conservatively between, say, 6.3% and 8.0%.
Which means?
It means Garmin is generating a massive positive spread between 11 and 13 percentage points between the return on their capital and the cost of that capital.
So this is empirical proof that every dollar they reinvest back into the core business is highly accretive to shareholder value.
Exactly. They have a high hurdle rate, and they're not just chasing low-return projects for the sake of top-line growth.
This high ROIC confirms the economic utility of their whole model. But you mentioned a crucial nuance that can trip up investors who only look at the headline numbers.
Yes. The crucial nuance is that this already stellar 19.4% ROIC is achieved despite the company holding a monumental amount of cash in short-term securities. We're talking about $3.9 billion.
Which are, by nature, very low-yielding assets.
Right. So because ROIC uses all invested capital in the denominator, that huge $3.9 billion cash pile acts as a structural drag on the reported return.
So if you were to strip that out?
Precisely. If we were to calculate ROIC purely on the operating capital needed to run the 5 core businesses, excluding that excess cash, the returns would be, well, astronomically high. probably over 30%.
That's incredible. It highlights the exceptional underlying economics of the core segments.
It's fundamentally a cash machine with enormous internal returns.
That's a perfect transition. Speaking of the cash machine, let's turn to the balance sheet itself. In a world where high leverage is being punished by rising interest rates, Garmin's financial structure is almost extremely conservative.
The balance sheet is truly a fortress. They generate powerful free cash flow, FCF, clocking in at $425 million in Q3 2025 alone. The full-year expectation for 2025 is around $1.3 billion.
And we have to check the quality of those earnings. Is the net income figure really backed by tangible cash?
It is. This is a critical check. Cash from operations, which hit $486 million in Q3 2025, actually exceeds the reported net income.
So no aggressive accounting or working capital shenanigans.
It signals very high-quality cash-backed earnings. And the final layer of insulation, their debt profile.
Which is?
Zero material long-term debt. And that $3.9 billion liquidity pile serves as a monumental financial buffer. It even generated a staggering $114 million in interest income in 2024 alone.
So that cash reserve basically acts as a subsidized R&D budget or a perpetual source for their dividend payments. It's financial insulation that's unmatched by many of their competitors.
It gives them exceptional optionality.
Okay, now we have to segment the analysis. Garmin isn't a single stock. It's a portfolio of 5 distinct businesses, and their growth rates and margin profiles vary wildly. This is crucial for understanding where the future value is coming from.
We have to separate the winners from the cyclical elements and the structural drag. Let's start with the undisputed growth star, the segment driving all the excitement right now, fitness.
The numbers here are huge. Q3 2025 revenue was $601 million.
Up 30% year over year. And that's coupled with a highly respectable operating margin of 32%.
30% growth is astonishing for a mature hardware segment of this size, especially with the competition it faces. And this wasn't just, a rising tide. This was a conscious strategic pivot.
A textbook strategic maneuver. Garmin's core weakness against Apple was display vibrancy. So the decisive move was this aggressive transition to AMOLED displays across their key lines, the Forerunner 265 and 965, the VNU series.
And that neutralized the Apple Watch's primary aesthetic advantage.
It did. It neutralized the bright, beautiful screen advantage while, crucially, maintaining Garmin's superior power management and advanced native training metrics.
So they successfully defended and consolidated their hold on this serious athlete niche. They're not trying to win the general smartwatch market.
No, they're dominating the segment that prioritizes performance, training data, and most critically, that endurance battery life. The sustained 30% growth validates the whole strategy.
Okay, let's move on to the outdoor segment. Historically, this has been the highest margin segment, the foundation of the modern Garmin brand.
The outdoor segment is the structural profit powerhouse, but we have to acknowledge it is facing some cyclical headwinds right now.
Revenue is down.
It was. In Q3 2025, revenue was $498 million, but it contracted by 5% year over year. Despite that dip, it is still Garmin's highest margin segment, clocking in at an impressive 34% operating margin.
That 5% contraction is an immediate reminder of the vulnerability in hardware businesses that are built on these multi-year product cycles. It's a hit-driven market.
It's the cyclical trap. The Q3 2025 decline is almost entirely due to tough comparisons against the prior year's massive success, which was the revenue spike from the Fenix 8 series launch.
So that set an unrealistic bar for growth.
It made replicating positive year-over-year growth mathematically very difficult. But despite the dip, the innovation pipeline isn't slowing. They're still pushing boundaries, like with the new Fenix 8 Pro.
Right, with the micro-LED technology.
Absolutely. That shows their intent to maintain display tech leadership in the rugged outdoor space. Micro-LED offers higher brightness for sunlight visibility and even lower power consumption than OLED,
which extends that all-important battery life for multi-day expeditions. And what's the structural element that protects this segment from that hardware cycle volatility?
It's the InReach satellite communication product line. This device provides essential satellite messaging and SOS capability when you're far outside of cellular range.
And it comes with a subscription.
Crucially, yes. The InReach service provides high-margin, recurring subscription revenue. This provides a structural dampener against the hardware volatility, providing stable income even in soft years.
Let's look at the regulated industrial side now, starting with aviation, which is often cited as their strongest structural moat.
Aviation is the gold standard for high barrier to entry businesses. Q3 2025 revenue was $240 million, growing at 18% year over year with a robust 25% operating margin.
And the moat here isn't just about the tech, it's almost entirely regulatory, isn't it?
It is. We're talking about multi-year, multi-million-dollar certification processes with the FAA in the U.S. and EASA in Europe just to get a product approved for one specific airframe. It's years of sunk cost.
That certification process is the ultimate barrier. Once a Garmin system, like their popular G1000 NXI avionics suite, is certified for a legacy business jet, it's functionally impossible for a competitor to displace it.
They'd have to repeat the entire costly certification process. Garmin essentially secures a multi-decade revenue stream from that airframe's upgrade cycle.
What's fueling the current 18% growth?
The key driver is the strong retrofit cycle monetizing the existing fleet. Specifically, strong demand related to the certification of Garmin's proprietary Autoland technology.
The system that can land a plane by itself in an emergency.
Exactly. The recent certification for retrofit on existing King Air turboprop aircraft is hugely significant. It opens up a massive long-tail addressable market of existing aircraft owners looking to upgrade their safety features.
Brilliant. Okay, let's move to marine. This segment is growing aggressively, largely through a strategic inorganic approach.
It is. Q3 2025 revenue was $267 million, up 20% year over year with a 19% operating margin.
And this growth was heavily supercharged by M&A, specifically in the accessory space.
Absolutely. The acquisition of JL Audio, a high-end marine audio provider, in late 2023 was a big one. And then Lumishore, a high-end marine lighting provider, in October 2024.
And the strategic rationale here goes beyond just adding product lines. It's about achieving what they call helm control.
Yes, explain helm control. What does that integration look like on a physical level?
So the objective is complete ecosystem dominance in the cockpit of the boat, which is called the helm. Garmin's strategy is to integrate high-end audio, sonar, lighting, everything directly into their proprietary one-helm multifunction displays.
And this requires deep software API standardization. By doing this, they offer boat builders a single, unified, turnkey electronic ecosystem.
Which dramatically increases the bill of materials that Garmin captures per boat.
Exactly. And more importantly, it creates a powerful platform lock-in. Once a builder commits to the one-helm display and its integrated APIs, it makes it incredibly hard and costly to mix and match competitor components from rivals like Simrad or Raymarine.
It's an ecosystem strategy focused on raising switching costs and maximizing captured value. The 20% growth validates it.
It does.
Finally, we have to address the persistent financial anomaly, the segment that's both a strategic conundrum and a financial drag. Auto OEM.
The strategic conundrum indeed. Q3 2025 revenue was $165 million, contracting slightly by 2% year over year.
And crucially, the operating margins were deeply negative.
A loss of $17 million. This segment consistently generates operating losses, carries a meager 15% gross margin versus the corporate average of 59%, and it significantly dilutes overall corporate profitability.
So it's the implicit tax on the high-quality earnings of the rest of the business. Why does management tolerate a consistently loss-making segment? What's the sophisticated justification?
Management offers two key strategic arguments. First, they argue the segment provides vital scale and component purchasing screens, microprocessors, memory chips that lowers costs across the much more profitable fitness and outdoor segments.
So the loss is justified if the cost savings in fitness and outdoor exceed the $17 million quarterly loss in auto OEM.
Precisely. The second justification is competency. The segment keeps Garmin on the cutting edge of complex computing hardware, developing high-tech domain controllers for major partners like BMW and Mercedes.
So they see it as a necessary high-stakes R&D lab.
Yes, one that maintains their technical superiority in computing architecture, which pays dividends elsewhere, even if the segment itself remains unprofitable on a standalone basis. The question for the investor is whether that cost is justified.
To justify a premium valuation, that moat has to be durable. We have to address the most significant competitive threat, the Apple Watch Ultra, which directly targets Garmin's most profitable consumer demographic.
The Apple Watch Ultra, with its rugged case, dual-frequency GPS, and long battery life by Apple standards, is a frontal assault on Garmin's weekend warrior customer.
And this is a competitor with an ecosystem and a marketing budget that Garmin just cannot match. How have they survived, let alone thrived?
By executing a highly successful market bifurcation. Garmin's strategy accepted they can't win the general smartwatch battle, the lifestyle features, the app store. So instead, they doubled down on the performance athlete market.
And that means focusing obsessively on three core advantages that Apple can't easily replicate.
First, battery life, which we discussed, 20-plus days. Second, physical utility. buttons that work when you're wet or wearing gloves. Third, deeply advanced proprietary training metrics that are native to the watch.
So they're playing two entirely different games. Apple dominates the lifestyle athlete, while Garmin maintains the professional and serious amateur market that values function and endurance.
Is there hard data proving the Ultra hasn't just cannibalized Garmin's core base?
Yes, the data is reassuring. Counterpoint research from Q3 2025 clearly indicates that while Apple leads the overall wearables market, Garmin continues to grow robustly in the premium segment, devices over $500.
So the Ultra appears to have expanded the whole rugged watch category rather than just stealing Garmin's established clientele.
Exactly. Garmin successfully retained its niche leadership through superior performance metrics.
Let's shift our critical focus to management, quality, and capital allocation. Stability is clear. CEO Cliff Pemble is a long-term veteran. The founding families retained significant ownership. But the key test is how they deploy their capital, especially that $3.9 billion cash pile.
This is the central friction point for sophisticated investors. We have a company generating $1.3 billion in FCF annually, zero debt, yet they're only executing share repurchases modestly.
Very modestly. They repurchased just $36 million in Q3 2025. That compares against a total FCF expectation of $1.3 billion for the year
It's tiny.
and a cash balance that is more than 100 times larger than that quarterly buyback.
That conservative execution is extremely telling. It signals that management, the people who know the business best, are profoundly price sensitive.
It's more than sensitivity. It's capital discipline taken to an extreme. Given their cash buffer, an aggressive management team looking to juice EPS would be buying back 10 times that amount.
So their decision to execute so modestly signals they believe the intrinsic value is potentially lower than the current market price of 25x earnings.
They are not interested in aggressively buying back shares at what they internally perceive as a peak valuation.
Yeah.
It's an indirect signal to the market.
So they're prioritizing the dividend and maintaining that liquidity over aggressively bidding up their own stock. How does this conservatism translate to their dividend policy?
It translates into strong confidence in the underlying business stability.
Hmm.
The reliable dividend, which they increased by 20% in 2025 to $3.60 per share, reflects management's deep conviction in sustained structural free cash flow generation.
And given their $1.3 billion FCF expectation, that dividend is easily covered.
Easily. They are committing to that growing payout regardless of minor cyclical dips, effectively returning the excess cash to shareholders through a consistent distribution.
Okay, let's synthesize this. We have established that Garmin is an exceptionally managed, capital-efficient, diversified compounder with deep structural moats. But that quality, that operational excellence, comes with a hefty price tag. So, what does this all mean for the high IQ investor considering a position today?
The valuation reality is unavoidable. Garmin is trading at approximately 25 times forward earnings. This is a substantial premium relative to its historical 18 by 22x trading range.
So for the market to assign this premium, it's pricing in not just success, but virtually flawless execution and accelerated growth.
Exactly. This is where the caution from institutions like Upslope Capital becomes tangible. At 25x, the risk is skewed heavily toward multiple compression if growth falters, rather than further multiple expansion.
The upside required to maintain this multiple is immense.
It is. Growth has to be sustained and accelerate in those high-margin segments. And this brings us to that critical structural headwind that is non-operational but permanently impacts EPS growth.
The rising effective tax rate. This is perhaps the most material structural negative development hitting their bottom line.
It's an external, non-controllable factor. And two specific legislative changes are responsible. First, the implementation of the OECD Global Minimum Tax Rules, Pillar 2, in Switzerland, where Garmin is domiciled.
And the second.
Changes to U.S. R&D capitalization rules, which now force companies to amortize R&D expenses over 5 years instead of expensing them immediately.
Okay, I get the R&D amortization impact. It artificially inflates near-term taxable income. But explain the Pillar 2 impact in Switzerland.
Garmin historically benefited from a lower effective tax rate due to its structure. Pillar 2 forces the Swiss government to raise its minimum corporate tax rate to ensure profits earned there are taxed at a global floor of at least 15%.
So, because of those two factors combined,
Garmin's effective tax rate jumped sharply to 21.2% in Q3 2025. That's a significant step up from 17.9% in the prior year.
and that is critical. This isn't a temporary issue. It's a permanent structural drag on net income and EPS growth that management can't mitigate through better operations.
That's the reality. It's an unavoidable external headwind that acts directly against the fantastic operational leverage we discussed. We also can't ignore the inherent cyclical vulnerability.
The softness in the outdoor segment?
That 5% contraction reminds us of the product cycle risk. If a future major launch, like the micro-LED devices, fails to ignite an upgrade cycle, you face stagnation in the company's biggest profit engine.
And finally, the unavoidable geopolitical exposure.
Their major manufacturing hubs are centralized in Taiwan. And while their vertical integration gives them remarkable agility, a major disruption from geopolitical tensions in the Taiwan Strait would be, well, catastrophic. It's a low probability, high impact risk.
And one that has to be factored in when you're assigning a 25x multiple to a company with centralized production.
Absolutely.
Given all of this, the indisputable quality, the moats, the fortress balance sheet, but also the peak valuation and the structural tax drag, what's the definitive investment verdict for the critical patient investor?
Garmin is indisputably a high-quality compounder. It's a best-in-class operator. However, the current premium valuation leaves little to no margin of safety against these risks. The investment verdict is hold watch.
So for current shareholders, you hold for the dividend and continued compounding. For prospective investors,
For prospective investors, patience is strongly advised. The appropriate entry point for a critical investor is waiting for a pullback, maybe driven by that cyclical softness or a geopolitical tremor toward the historical average valuation range of 20 times earnings. That provides a far healthier risk-reward profile.
it is the ultimate challenge for the quality investor, isn't it? Recognizing the excellence of the business while resisting the urge to overpay for that quality.
This raises an important question, one of conviction versus caution. Let's go back to the disciplined capital allocation. Management has full authorization and that massive $3.9 billion cash pile.
Yet they only used $36 million on share repurchases in the quarter.
That's less than 3% of their quarterly free cash flow spent on buying their own stock. Given their deep knowledge of the business and their fiduciary duty, is that extreme conservatism merely discipline?
Or is it a powerful indirect admission that they, too, believe the stock is fully valued at current prices?
If the people who know the intrinsic value of Garmin better than anyone else are hesitant to aggressively purchase shares at the current price,
Then perhaps the critical investor should be asking if the real opportunity lies in waiting, not in buying. It's a powerful signal to mull over.